Okay, sales of block stock sales, mutual fund capital gain distributions, and sales of shares from mutual funds. We'll talk about what mutual funds here. Some of you may know what they are, some of you may not know what they are. So what they mean by sales of block stock, when you've got stocks, the same stock that's purchased on different dates. So let's say I bought 30 shares of Microsoft on 11/14/19 at, I don't know what the share price was doing, but let's just say $200 a share. So my basis is going to be how the number of shares that I purchased times the price per share, right? So 30 times 200, 6,000 is my basis. I have a per share basis of $210. Then I bought an additional 20 shares of Microsoft on 12/4/20, and it was $250 a share. So now my basis is 5,000 in those. That's $250 a share. Then I bought another 10, 11/14/23. Well, that's not even. Let's do 21 so that it's long term. And it was $300 a share. So my basis here is $3,000. My total basis in my Microsoft shares is $14,000. And I have 60 shares. So what happens if I sell 50 shares? I sell 50 shares of Microsoft. How do I know which ones I've sold? I need to know that because I need to know the basis in order to calculate what the gain is, right? Or loss. All right, so I sell 50 on 11/12/23, and the price is $400 a share. So my proceeds 50 times are $20,000, right? So I got $20,000, but I need to determine what my basis is for those 50 shares. I've got a few choices. We could choose specific identification, where we say, okay, we sold these 10 shares, these 20 shares, and then 20 of those shares. If we did that, our basis is going to be higher, right? Because our price went up. So that means our gain is going to be lower. Or we could say, okay, well, we sold both of these lots here, which means our basis would be $11,000. If we sold both of these, so let's say we sold these and these. The basis is $11,000. Our gain is $9,000. Long term, everything's over a year, so we're going to get those preferential tax rates. But we could do it that way. Or we could say, tell you what, we're going to take 10 from here and 20 from here and 20 from here, which means our basis on this one, this is a times $300 a share, basis is 3,000. I don't know why I had to calculate that out, it's right there. All 20 of those, basis is 5,000. But 20 of these, my basis was $200 a share, so this is 4,000. If this can be seen on here. Probably not. Sort of. If we did that, so 9, 10, this is a $12,000 basis. Now, sorry about the squeak. Now our gain, whoops, 12,000 basis, sorry, 20,000. Now our gain is $8,000. We can do that. We can pick and choose. And then what we have left are 10 shares that we bought on 11/14/19 for $200. So our remaining basis, at some point we're going to have to pay tax on that probably if it keeps gaining, right? But that we could specifically identify which shares we want to choose to sell. Another way of doing it is first in, first out. You guys are all familiar with that with regard to inventory. That means it's the first scenario that we looked at. So we sold these and we sold these. So there's our $11,000 basis. Oops. $20,000 proceeds, sorry. $9,000 gain. Another zero there. Another way to do it is to average it. If you average it, so there's our $14,000 basis. We're going to take our total basis, divide it by the total number of shares that we own, 60. Gives us an average basis of $233.33 times the 50 shares that we sold. I'm sorry, yeah, 50, sorry. 11,667. So now our gain, 20,000 proceeds minus 11,667 basis is what? 8,333, something like that, is our gain. That means that our remaining 10 shares have an average basis of $233.33 each. And that's what we'll have to use in the future, right? So, 3 different ways that we can do it. Specific identification, first in, first out, or we can do an average as well. Did I just go, like, what are they talking about here? Oh, there's our Schedule D. Hold on. I want to make sure that yeah. So this is the same sort of example, different ways of doing that. So that's one of the things you can do when you buy the same stock at different times, and each of those blocks have different bases. 3 different ways you can calculate them when you're trying to calculate that gain. Does everybody know what a mutual fund is? I know I know that not everybody does, so I will explain. So a mutual fund, you can buy individual shares, like I just did here, Microsoft, or another option is to buy a grouping of shares. A mutual fund is a type of fund where somebody manages it, like a professional money manager manages the fund, and they choose a grouping of stocks to put together into this fund. So it pools it, spreads out the risk, right? So they'll buy, let's see, it's a technology mutual fund. It can be focused on different things. It could be focused on a sector of the economy, a particular industry. It could be focused on, some of them are, okay, so you want to retire by 2040. These are the stocks that we're going to put you in that we think will get you to where you want to be by 2040. So they're like targeted funds. There are mutual funds that follow certain indices, like the Dow Jones or the New York Stock Exchange. There are, they're all different, just hundreds, thousands of different types of mutual funds. There are mutual funds that you can buy into that will, like, whatever your social beliefs are. So, like, if you're really into the environment, you want to invest in companies that you think are good for the environment. There are mutual funds out there that are centered around environmental types of things. So all of that stuff, all different types of combinations. But they do, what the manager of that mutual fund picks and chooses different stocks that match the philosophy of that mutual fund. So for example, a technology fund, maybe even like an AI fund, one that's really focused in on a particular type of technology, might include, like, I don't know, what would it include? What are some AI companies? I mean, pretty much all of them are AI companies now. Maybe that's a bad example because my knowledge base isn't real great. Nuclear energy. Say you're in, by the way, nuclear energy is becoming popular again, FYI. It's clean energy. So they'll pick and choose different funds that are like people who mine uranium, or they work somehow in the nuclear field. So they'll just put all of those together. And it's a conglomeration of these different stocks. And the mutual fund itself has a price, has a share price that's based on the value of all of the stocks together in that mutual fund. So what it does, like I said, it kind of spreads out the risk. So instead of just investing in one company, you can invest in a grouping of companies. And so if one company goes under, does really poorly, you've got the benefit of these other companies that kind of make up the slack. And ideally, with a professional fund investor, that person, again, ideally knows what they're doing and can pick which upcoming companies should be added to the fund or which companies should drop out of the fund and that sort of thing. So you as the investor don't have to do that. So mutual funds, you buy into these. What happens is during the entire year, the fund manager is buying and selling stocks. They're selling, and they may be changing the ratio of different investments. They're buying and selling this all the time. Well, that accumulates capital gains and capital losses throughout the year, right? If you, as an individual, sell a stock, you're going to have probably a capital gain or a capital loss that you have to report. Mutual funds what they do is they blend all of those capital gains together at the end of the year. And you get what's called a capital gain distribution. Capital gain distributions are always taxed at long-term capital gains tax rates. So even if the sale was short-term, it's going to be taxed at a long-term capital gains rate. When you get your statement at the end of the year from the brokerage, if you have these mutual funds, it just has a line for capital gain distributions. You don't have to calculate it as the investor. The brokerage does all of the calculations. But all of that does have to be reported. And so that's what these are, the capital gain distributions. Doesn't necessarily mean that you're going to get the cash. You may have chosen to reinvest those capital gain distributions. So instead of giving it back to me, giving the cash back to me. I just want to buy more shares of the mutual fund. So it increases my value in that mutual fund. You still have to pay the tax on it though. But what those capital gain distributions do then is increase the basis of your mutual fund. So if I bought shares of a mutual fund, let's say I bought 50 shares, and mutual funds, by the way, so you saw the Microsoft ticker, MSFT. Tickers are the names that are on the stock exchange. They'll either be like one letter up to, I think, 4, something like that. I don't know if they're 5. Mutual funds are always like 5 letters long. So if I'm going to buy 50 shares of A, B, C, D, F, E fund, and right now it is selling for $100 a share. So my basis in that purchase is $5,000, total basis. And I bought this in 2019. So in 2020, I didn't sell it, but what happened is I got a capital gain distribution. And I reinvested that capital gain distribution. They calculated what it was, and let's say that reinvestment got me 2 more shares of, so here's my capital gain distribution. 2 more shares, essentially. So I got the cash, but then they turned around and bought more shares for me. So 2 more shares, and the capital gain distribution, the value on my brokerage statement was $100. So what that does is it's going to increase my basis by $100 because I'm going to pay tax on that $100 in 2020. And then let's say in 2021, 3 shares were reinvested, and it was $150. So now my basis is $150 increased. And then 2022, 4 shares, make this easy, and it was $200 per share. So plus, did I do that right? That should be, that's 3 shares, I'm sorry, at 150, no, total was 150. So added $200 to my basis. So now my basis in the stock is, what is it, $5,450. I'm paying tax on this all along the way. Okay, it's being reported on my Schedule D as a capital gain distribution. So that means when I sell it, I don't have to pay tax on that again. That's going to be included in my basis, and that's how I don't pay tax on it a second time. And now I've got 9 shares. I've got 59 shares of ABCDE fund, and my total basis is $54.50. I sell 20 of these shares. We're going to average that. So $54.50 divided by 59. 59 shares. So $92.37 average. The reason it's lower is because these were flat amounts. They weren't based on the number of shares, but I just got those additional amounts of shares, right? So $92.97 is my basis times 20. $18.47. And if I sold those 20 shares, and at the time it was at, well, let's say it was $120 a share. So 2,400. My proceeds were 2,400. My basis was 1847.45. I still have 39 shares of it sitting out there but the basis of those 39 shares then is going to change throughout time as I get more capital gain distributions. Also, mutual funds will issue dividends. So they'll pay out dividends because those individual stocks pay dividends. So when that happens, I get my share of those dividends. By the way, this fund, I'm in this fund with thousands and thousands of other people who have invested together. Okay, so that's kind of how at a basic level anyway, how the capital gain distributions work. And there are no, so everything is, like if there are no capital gains during the year, you wouldn't get that reported to you at all. So that's gonna go, oh, they don't have do they have the Schedule D here? So I can show you where it is. Capital gain distributions, line 13. They go right here on the Schedule D. Again, those get reported, not something that the investor has to calculate. The brokerage calculates that for them. All right, what else do I want to say here? So we talked about capital gains, we talked about block sales. Well, this goes through all of that about mutual funds. That's another example. I'm not going to go through that. That's different. So this shows average basis, specific identification, first in, first out, how to do those calculations. Already did that as well. Worthless securities. It happens. You invest in a company and they go bankrupt and you get nothing out of it. You actually can get a capital loss for that. It is a capital loss. You have to, so the fact that the company is declaring bankruptcy is usually not enough to indicate worthlessness, because oftentimes investors will get paid something in bankruptcy. So loss on a worthless security is assumed to occur on the last day of the taxable year when it's determined that it is worthless. What else? Oh, this is the 1099. Well, this is a 1099B. Actually, they hardly ever look like this. So this is what a broker would send out. So if you sold stock, they would tell you what the proceeds are, tell you whether it's short-term or long-term, whether those proceeds were reported to the IRS. Remember, that's one of those indications on the 8949. Was it reported to the IRS? Lots of other boxes here that you don't really need to focus on. Cost or other basis, if you knew it. If they didn't know it, and it's possible that they don't know what your cost was. If you started at another brokerage and then you transferred all of your investments to a new brokerage, that new brokerage might not know, unless you tell them, might not know what the basis is. So a lot of times, and in the early days of preparing taxes, I spent a lot of time trying to calculate basis for people, because at the time, none of the brokerages gave you the basis. Even if they knew it, they didn't give it to you. So you had to calculate it. It was very time consuming, especially if you're talking about people who had reinvested stuff over the last 20 years and the stocks had split and other companies had bought the company, and it could get really complicated. It's much more simple now. You're familiar with the 1099 DIV. So there's our capital gains, which we just looked at, or Schedule D. Just trying to see if there was anything else in this section that I missed. Oh, so inherited property, again, same thing. So it's just determining the basis. And remember, if it's inherited, it's always going to be long-term. And the basis is going to be whatever the fair market value was on the date of death of the individual. Gifted property, you're going to step into the shoes of the person who gave it to you. So whatever if it was long-term or short-term to them, that's what you're going to use. And you're also going to step into their basis, right? Oh, okay. So at the back of your book, or at the back of this chapter, they've got this chart that kind of gives you a rundown of the different types of assets. May or may not, it probably be helpful to you, just to kind of, this is the same chart that they had earlier in the chapter, what the different types of assets are, how the gains and losses are treated as well, where it's reported, an example of what type of asset it is. Okay, let's see, was there anything else? Mutual fund, sales of shares of, yeah, I think I talked about it all. Any questions? No, okay, so